In the early months of 2026, the global financial landscape is no longer just a challenge, it is a battlefield where the weapons are interest rates and the casualties are those who failed to adapt. Imagine standing on a thin tightrope stretched between two skyscrapers. One represents the abyss of hyperinflation, and the other the canyon of a deep economic recession. This is exactly where the Federal Reserve and central banks worldwide find themselves today, balancing precariously while the winds of geopolitical instability howl around them. You might have thought that by now, the aggressive tightening cycles of previous years would have finally tamed the beast of rising prices. Yet here we are, facing a reality where inflation remains stubbornly sticky and businesses are gasping for air. The promise of a return to the easy money era has evaporated, replaced by a harsh new dawn where capital has a high price and survival requires surgical precision. This persistence of inflation is not a fluke or a simple delay in policy transmission. It is a fundamental shift in the global economic DNA caused by deep-seated structural changes. While central banks have hammered away with interest rate hikes, the traditional cures are hitting a wall because the root causes have shifted from excess demand to a fractured global supply chain. We are witnessing a phenomenon where geopolitical realignment has forced nations to prioritize friendshoring over cost efficiency, meaning the cheap goods that fueled the low inflation decades are gone for good. When you analyze the situation through the 5 Whys lens, you realize that businesses are not just struggling with high prices, but with a real interest rate that is at its highest point in over a decade, creating a suffocating environment for any entity reliant on leverage. To understand the gravity of 2026, we must look at the hard data. The Consumer Price Index, CPI, remains hovering around 3.2%, mocking the Federal Reserve's long-standing 2% target. This gap is not just a number on a spreadsheet, it represents a loss of purchasing power that erodes the very foundation of consumer confidence. Furthermore, the bond market is screaming a warning through a persistently inverted yield curve, where short-term debt yields more than long-term debt. Historically, this is the most reliable harbinger of an impending economic contraction, signaling that investors have lost faith in the near-term growth prospects and are bracing for impact. We are currently staring at a debt wall where trillions of dollars of corporate loans taken out during the low-rate era of 2020 to 2021 are coming due for refinancing at rates that have doubled or even tripled. Consider the story of a mid-sized electronics manufacturer in late 2024 who decided to take a gamble on a massive facility expansion, fueled by a variable rate loan and the hope that rates would surely drop by 2026. Fast forward to today, and that owner is facing a brutal choice: liquidate assets at a loss to cover the surging interest payments, or pray for a pivot that the Fed has repeatedly signaled is not coming. This is the sunk cost fallacy playing out on a global scale, where the stubborn hope for a return to the past prevents the necessary restructuring for the future. The reality is that high interest rates are not a temporary poison, they are a bitter medicine intended to purge the system of zombie companies that only existed because money was essentially free. The importance of this moment cannot be overstated because we are entering a phase of stagflation 2.0, reminiscent of the 1970s, but far more complex due to our interconnected digital economy. In the 70s, the world wasn't managing a global debt-to-GDP ratio that exceeded 300%. Today, every percentage point increase in rates puts an exponential strain on sovereign balance sheets, forcing governments to choose between servicing their debt or funding essential public services. This is why you must understand the how-to of survival in this high-rate regime. It begins with a radical audit of your personal or corporate balance sheet to eliminate any debt that does not directly produce a return higher than the cost of capital. If your ROI is 8%, but your loan is 9%, you are not running a business, you are slowly burning your house to stay warm. A common mistake many investors are making right now is bottom fishing, buying assets just because they are cheaper than they were 2 years ago. In a high-rate environment, cheap can always get cheaper if the underlying cash flow cannot support the debt. To avoid this trap, you must pivot towards quality and liquidity. This means prioritizing companies with high moats, zero net debt, in the ability to pass on costs to consumers without losing volume. The era of speculative growth, where companies could lose money for a decade while chasing users, is officially over. We have returned to the fundamental laws of economics, where cash is king and profit is the only true measure of viability. Let's talk about a bold, perhaps even controversial perspective. The 2% inflation target is a relic of a world that no longer exists. I argue that for the global economy to survive without a catastrophic collapse, central banks must eventually accept a new normal of 3% or even 3.5% inflation. Trying to crush inflation back down to 2% in a world of deglobalization and labor shortages might require a level of economic pain that society is unwilling to bear. We are seeing a quiet shift in the narrative, where stability is becoming more important than target precision. If the Fed refuses to bend, they risk breaking the back of the very labor market they seek to protect, leading to a deflationary spiral that could be even harder to escape. However, there is a glimmer of hope in the form of AI-driven productivity. While traditional sectors are reeling, the integration of generative AI into professional workflows is starting to show real gains in output per hour. If AI can help a company do more with fewer people, it acts as a natural deflationary force, offsetting the pressure of rising wages. This is the great decoupling of 2026. Sectors that can automate will thrive, while labor-intensive industries that cannot pass on costs will face an existential crisis. Your strategy should be to align yourself with the victors of this technological shift, using the current market volatility to build positions in the efficiency titans of the next decade. As we navigate these turbulent waters, remember that a high-rate environment is actually a massive opportunity for the disciplined and the patient. While the get-rich-quick crowd is being wiped out by margin calls, the savvy operator is sitting on a pile of dry powder, waiting for the inevitable fire sales of high-quality assets. Implement a 3-2-1 strategy immediately. Allocate 30% of your portfolio to defensive assets like gold or short-term treasury bills. Reduce your high-interest debt to below 20% of your total value, and keep at least 10% in pure cash. This cash isn't trash. It is your ticket to the greatest wealth transfer of the 2020s, when the debt wall finally forces the over-leveraged to sell their crown jewels for pennies on the dollar.
True financial mastery in 2026 is not about predicting when the Fed will cut rates. It is about building a life and a business that is anti-fragile, getting stronger when the system is stressed. This requires a level of discipline and Marshall-like rigor in your financial planning. You must be proactive, not reactive. You must be the one who provides liquidity when everyone else is desperate for it. This isn't just about money, it's about the freedom that comes from being the master of your own economic destiny, while others are slaves to the central bank's whim. Stand tall, stay liquid, and be ready to act when the moment of maximum pessimism arrives. If you were sitting in the chair of the Federal Reserve today, would you prioritize saving the value of the currency, even if it meant a 10% unemployment rate? Or would you allow inflation to run hot to save the jobs of millions? This is the defining question of our generation. To help you navigate these choices, I have prepared a comprehensive 2026 financial resilience checklist that details exactly how to stress test your assets against another year of high rates. Success in this era belongs to the bold and the prepared. As the world enters the midpoint of 2026, we are witnessing the birth of a dual-track global economy that looks nothing like the era of free market globalization we once knew. The old system, built on the backbone of the US dollar and frictionless trade, is undergoing a tectonic shift toward a regional blocs and digital sovereignty. This isn't just an evolution, it's a revolution, where the very definition of money is being rewritten by central bank digital currencies, or CBDCs. We are moving from an age of just-in-time efficiency to just-in-case resilience. And if you aren't prepared for the rise of the programmable dollar and the new trade corridors, you aren't just falling behind, you are becoming obsolete. The primary driver of this transformation is the realization that economic interdependence, once thought to be a guarantee of peace, has become a weapon of war. We are seeing the great fracturing, where the world is splitting into two distinct technological and financial ecosystems, the Western-led transparency bloc and the BRICS plus sovereignty bloc. This isn't just about politics, it's about the fundamental infrastructure of how value moves across borders. While the US and its allies lean into sanctions-based financial oversight, the rest of the world is frantically building off-ramps to bypass the traditional SWIFT system. This is why you see the unprecedented accumulation of gold by central banks in 2026. They aren't just hedging against inflation, they are building a bridge to a post-dollar world. Let's dive into the why behind the sudden acceleration of CBDCs. For years, digital currencies were treated as a futuristic experiment, but in 2026, they have become an essential tool for survival. Central banks have realized that traditional monetary policy is too blunt. Raising interest rates affects everyone, even the sectors that are already struggling. A CBDC, however, is programmable. It allows the government to inject liquidity directly into a specific industry, like green energy or semiconductor manufacturing, while keeping the rest of the economy under tight credit conditions. This is surgical monetary policy, and it represents the most significant increase in state economic power since the end of the gold standard. Imagine a small business owner in 2026 who receives a government grant that must be spent within 30 days and can only be used for local suppliers. This isn't science fiction, it's the reality of programmable money. While this offers a powerful tool to prevent total economic collapse during a recession, it introduces a level of surveillance and control that we have never seen. The how-to of navigating this new world requires you to diversify not just across assets, but across jurisdictions. If your entire net worth is tied to a single digital currency ecosystem, you are vulnerable to policy-driven deplatforming. True financial security now requires a blend of high-tech digital assets and low-tech physical tangibles. A common mistake today is assuming that the dollar's dominance will vanish overnight. It won't. The dollar trap is real. Too many nations hold too much dollar-denominated debt for the system to simply evaporate. Instead, we are entering a multi-currency transition where the dollar remains the primary unit of account, but a significant portion of actual trade, particularly in oil and commodities, shifts to local currencies or regional digital tokens. This creates a massive forex volatility zone. If you are a business importing goods, your biggest risk isn't just the price of the product, but the wild swings in currency parity caused by these geopolitical shifts. Think of the current global trade environment as a game of high-stakes chess where the board itself is changing shape. The rise of the IMEC corridor is a direct counter to China's influence, creating a new vertical trade axis that bypasses traditional choke points. For investors, this means the emerging markets of the past are being redefined. India, Vietnam, and Mexico are no longer just low-cost manufacturing hubs. They are the new strategic pillars of the global supply chain. If your portfolio is still 90% weighted towards domestic US or European equities, you are missing out on the reshoring boom that is pouring billions into these new economic powerhouses. The integration of AI into this geopolitical struggle is the ultimate X factor. We are seeing AI nationalism, where countries are hoarding computing power as if it were oil. The nations that can combine cheap energy with advanced AI will be able to out-manufacture and out-innovate their rivals, regardless of labor costs. This effectively kills the old development model of export-led growth via cheap labor. In 2026, a robot in Ohio can be more cost-effective than a worker in a developing nation once you factor in shipping and geopolitical risk. This is the great reshoring, and it is bringing high-tech manufacturing back to the
the core, with one catch: it creates wealth without creating millions of traditional jobs. This brings us to a radical conclusion. The traditional business cycle is being replaced by a policy cycle. In the past, economies grew and contracted based on consumer demand. In 2026, they grow or contract based on whether they are aligned with the prevailing geopolitical and technological trends of their bloc. You must stop thinking like a traditional investor and start thinking like a geopolitical strategist. Every investment you make should be stress-tested against the possibility of a decoupling event. If a company relies on a supply chain that crosses a geopolitical fault line, it is a high-risk asset, no matter how good its quarterly earnings look.
To thrive in this new normal, you must adopt a bimodal strategy. On one end, you need exposure to the technological frontier, AI, robotics, and energy transition companies that are backed by state mandates and subsidies. On the other end, you need hard assets that exist outside the digital grid: physical gold, productive farmland, and critical minerals. This is how you protect yourself against both the inflation of the old system and the volatility of the new one. You are effectively building your own sovereign wealth fund at a household level, ensuring that no matter which currency or block comes out on top, your family's prosperity is secured. We are standing at the threshold of a new era of human organization, where the lines between finance, technology, and national security have blurred into a single unified struggle for dominance. This is not a time for the faint of heart or the indecisive. It is a time for those who can see the patterns in the chaos and have the courage to act before the window of opportunity closes. The world of 2026 is harsh to the complacent, but incredibly rewarding to the disciplined. You must be the architect of your own resilience, the master of your own capital, and the visionary who sees the future while everyone else is still arguing about the past. The shift towards CBDCs and regional trade isn't just a change in the rules, it's a change in the game itself. Are you prepared to manage your assets in an environment where money has an expiration date or can only be spent on approved goods? The era of total financial privacy is ending, but the era of precision wealth building is just beginning. By aligning your strategy with these unstoppable global trends, you aren't just surviving the transition, bypassing the risks, you are positioning yourself to lead in the new world order. As we move deeper into the second half of 2026, the most profound change isn't happening on a balance sheet or in a central bank vault. It is happening inside the mind of the global consumer. The prolonged exposure to high interest rates, the looming debt wall, and the constant hum of geopolitical tension have birthed a new psychological archetype: the strategic minimalist. Gone are the days of mindless consumption fueled by cheap credit and the YOLO mentality of the post-pandemic era. In its place, we see a consumer who is disciplined, skeptical of marketing, and hyper-focused on utility per dollar. If you are a business leader or an investor still trying to sell the 2021 dream to a 2026 audience, you are speaking a dead language to a crowd that has moved on. This psychological shift is a direct result of economic scarring. When people watch their mortgage payments double while their grocery bills remain elevated, their relationship with money changes from a tool of expansion to a tool of defense. We are seeing the death of the middle-tier brand. The 2026 consumer is barbelling their spending. They will buy the absolute cheapest, generic version of a commodity to save money, but they will simultaneously pay a massive premium for a high-value experience or a product that offers a guaranteed long-term ROI. There is no middle ground left. You are either a cost leader or a value titan. Why is this happening now? Because for the first time in a generation, the cost of waiting has become a positive factor. In an era of 0% interest rates, there was no penalty for spending today. In 2026, with high-yield savings accounts and money market funds offering a steady 5% or more, every dollar spent on a non-essential item is a dollar that loses out on compounding returns. This is the opportunity cost awareness that has permeated even the average household. People are no longer just asking, "Can I afford this?" They are asking, "Is this worth more than 5% guaranteed growth over the next year?" This mental shift is the ultimate inflation killer, but it also means that economic growth will be much harder to achieve through traditional retail. To succeed in this environment, you must master the art of the essential. This means your product or service must solve a top 3 problem for your customer. In 2021, you could thrive by solving the 10th or 12th problem on someone's list: convenience, aesthetics, or status. In 2026, if you aren't solving their problem of how do I save time, how do I save money, or how do I secure my future, you are invisible. This is why the subscription economy is facing a massive Great Unsubscribe event. People are auditing their digital lives with a butcher's knife, cutting away any service that doesn't provide a daily measurable benefit. Consider the case study of the smart home market. A few years ago, the goal was to make everything smart, from toasters to light bulbs. In 2026, those products are gathering dust. Instead, the companies that are winning are those providing energy intelligence, systems that automatically optimize home electricity usage to take advantage of off-peak hours and save the homeowner 30% on their utility bill. This is the how-to for the next 5 years. Don't sell cool, sell efficiency. If you can prove that your product pays for itself within 12 months, you have a license to print money in 2026. One of the biggest mistakes companies are making right now is trying to use a fear-based marketing to drive sales. The 2026 consumer is fear-fatigued. They have lived through a global pandemic, a period of historic inflation, and the threat of regional wars. They have developed a psychological callus against doom and gloom messaging. Instead, the brands that are skyrocketing are those that provide optimistic certainty, a clear, disciplined path to a better outcome. The tone of the winner is not "the world is ending, buy this," but rather "the world is changing and here is how we win together." This brings us to the rise of the authenticity economy. In a world flooded with AI-generated content and deepfakes, the value of a verified human connection has reached an all-time high. People are moving away from global mega-influencers and toward micro-trust circles, local communities, specialized professional networks, and niche experts who have a track record of being right. For businesses, this means your brand equity is no longer built through expensive Super Bowl ads. It is built through radical transparency. If you make a mistake, admit it instantly. If your costs go up, explain why. The 2026 consumer will forgive a price hike, but they will never forgive a lie. We are also seeing the emergence of time as the new currency. As AI automates more of our tasks, the value of a human hour is being repriced. Services that can give someone back their deep work time or their quality family time are the new gold mines. This is why the longevity and wellness sector is exploding. People realize that in an era of high-pressure economic shifts, their greatest asset is their own physical and mental resilience. They are investing in biological upgrades, from advanced nutrition to personalized sleep optimization, as a way to maintain a competitive edge in a world that moves faster every day.
Looking forward, the sectors that will dominate the recovery are those at the intersection of hardware and intelligence. We are entering a CapEx supercycle, where billions are being spent to rebuild the physical world: energy grids, high-speed transport, and automated factories. This isn't just about software anymore, it's about the steel and silicon that makes the digital world possible. Investors who move away from pure SaaS, software as a service, and toward HaaS, hardware as a service, or industrial tech, will be the ones capturing the massive government and corporate spending aimed at national resilience. The 2026 mindset is one of pragmatic heroism. It is about looking at a difficult reality and deciding to build something durable anyway. It is about the discipline to save, the courage to invest in quality, and the wisdom to ignore the noise. You must align your personal and professional life with this high-integrity, high-utility framework. Stop chasing the next big thing and start building the next lasting thing. The world doesn't need more disruption, it needs solidification. It needs leaders who can act as anchors in a storm. You are the architect of your own perception.
In a world that feels increasingly chaotic, your ability to remain calm, focused, and value-driven is your greatest competitive advantage. By understanding the shift in the consumer soul, you can position yourself to provide the exact value the world is starving for: truth, efficiency, and resilience. This is the path to not just surviving the 2026 landscape, but owning it. As we approach the final stretch of 2026, the fog of uncertainty is finally lifting, revealing a landscape where only the most disciplined and adaptable have remained standing. We are no longer waiting for a return to normal because we have realized that the new normal is already here, and it is a world that rewards precision over volume and resilience over growth at any cost. This is the moment where the strategic minimalist consumer and the policy-driven economy converge, creating a window of opportunity for those ready to execute a radical pivot. The Great Rebound isn't a tide that will lift all boats. It is a selective surge that will propel only those who have cleared their decks of debt and aligned their sails with the technological and geopolitical winds of the future. The ultimate 2026 execution roadmap begins with a brutal zero-based audit of your entire existence: financial, professional, and digital. You must look at every asset, every subscription, and every professional relationship and ask, if I didn't already have this today, would I fight to get it back? In a high-interest rate environment, the cost of carry for mediocrity is too high. This is the how-to of the first phase. Liquidate your zombie assets, those investments or projects that have been flatlining for years, and consolidate that capital into high-conviction core positions. Speed is your greatest ally here. The debt wall is still claiming victims, and you want to be the one with the cash when the highest quality assets are forced into the liquidation zone. Step 2 of the roadmap is the skill set reshoring. Just as nations are bringing manufacturing home, you must bring your value proposition home to the things AI cannot easily replicate: high-level strategy, complex empathy, and physical world problem-solving. If your job consists of moving data from one spreadsheet to another, you are in the crosshairs of the AI automation wave. The actionable value here is to pivot toward AI orchestration. Don't just use the tools, design the workflows that integrate them into the physical economy. The most valuable person in 2027 will be the one who can bridge the gap between a digital algorithm and a physical supply chain. Why is this transition so urgent? Because the CapEx supercycle we discussed is about to move from the planning phase to the massive execution phase. Governments and corporations are pouring trillions into sovereign infrastructure, things like localized power grids, autonomous logistics, and deep tech healthcare. To capitalize on this, you must follow the subsidy. In 2026, the free market is heavily influenced by state mandates. Whether you are an investor or a career professional, you want to be positioned in the sectors that the government has deemed too strategic to fail. This isn't just about picking stocks, it's about picking a side in the global realignment. A common mistake in this phase is premature optimism, thinking that the first sign of a rate pause means it's time to go back to 200% leverage. Avoid this trap at all costs. The new normal interest rate floor is likely much higher than the 0 to 2% we were used to. The winners of the next decade will be internal growth engines, companies and individuals who can fund their own expansion through cash flow rather than debt. Your goal should be financial sovereignty, where your lifestyle and your business are shielded from the volatility of the central bank's decision-making process. Consider the case study of the microfactory. While global giants are struggling with shipping delays and currency wars, small, highly automated local production units are thriving. They use local energy, local AI talent, and serve a local micro-trust circle. This is the blueprint for the Great Rebound: smaller, smarter, and closer to the end user. Whether you are building a brand or a portfolio, think modular. Can your life survive if one module of the global economy fails? If the answer is no, you need more redundancy.
As we look toward the horizon of 2027 and beyond, the final step of the roadmap is radical transparency and community building. In an era of CBDCs and programmable money, your reputational capital is the only asset that cannot be frozen or devalued. You must build a moat of trust around your personal brand or your business. This is done through consistent, high-integrity action over time. In a world where everything can be faked, the real becomes the ultimate luxury. Connect with your peers, share your knowledge, and build a network that functions as a mutual defense pact against economic volatility. The message of 2026 is one of pragmatic hope. Yes, the old world is dying, but the one being born is far more efficient, transparent, and resilient. You are not a victim of these changes. You are the architect of your response to them. The great rebound belongs to those who see the debt wall as a hurdle, not a dead end. It belongs to those who see AI as a partner, not a predator. And most importantly, it belongs to those who have the discipline to stay the course when others are panicking. This is your moment to take the 3-2-1 strategy, the barbell consumer insights, and the policy-driven framework, and turn them into a singular, decisive plan of action. The time for waiting and seeing is over. The time for acting and leading has arrived. You have the data, you have the strategy, and you have the vision. Now go out and claim your place in the new economic order. The future isn't something that happens to you. It is something you create with every disciplined decision you make today. Stay bold, stay liquid, and stay focused on the essential. The era of the great rebound is here, and you are ready.